Okay. Uh, Once again, welcome to this session of your strategic financial management. So, we shall discuss regarding profit maximization and wealth maximization as the two important objective of financial management. Now, speaking about objective, we always try to tell it in the context of describing a goal or a decision that has to be made in taking some of the finance related decisions. Now, this objective, it could be a profit maximization or it could be shareholders wealth maximization. It will always provide a framework or what we call as a roadmap within which all the optimal financial decisions can be taken by an organization. Now, no matter what decision it takes, the objective of financial management should always be derived out of the wider corporate vision and mission, along with the goals and objectives of the organization that it has set for itself. And therefore, the objective of financial management would be the financial part of overall cooperative objectives and would therefore be always in harmony with wider organizational goals. Now, it will provide a basis to attain financial targets with the required cooperative goals. So, let us try to understand this profit maximization in detail as one of the objective of financial management. Now, speaking about profit maximization, now it could be any business organization, the largest business organization that is present, the smallest one, the one which is being doing its business for our centuries, or the one business which has been started a day earlier. Now all the firms, they either produce goods or services. They are sometimes function in a market controlled government or sometimes in government controlled economy. All they do the business with the main aim of earning some kind of profit for their business and to achieve the aims that it has set for itself. Now, speaking about the market economy, in the market economy, the price of goods and services are always determined or decided in the competitiveness. Now, any firm that has situated itself in the market economy is expected to produce goods and services that are decided by society, and also it is to be produced in the most efficient way possible. Now, in a market system, price is the most important organ of such kind of economy. It indicates what goods and services society wants. Now, in market, the goods and services which has great demand can always command higher prices. Now, this results in high profit for firms. Now, if more of such goods and services are produced, higher profit opportunities will always attract other firms to produce such goods and services, and ultimately, with the increasing competition, it brings in the market a situation which we call as an equilibrium price, which is at that point the demand and supply of the product match. Now all these are economic terms, and I hope you have discussed this in your first semester and second semester, and that you have not forgotten. It simply means to tell a company in a market situation will always have to produce goods which are desired by the society. And when it does that work, it will always have more demand for its products. And also, it is the way of market that when there is more demand for their particular product, and that they know that they have the advantage of being monopoly, they try not to supply the goods equivalent to the demand, thereby increase the profit more and more and earn more and more. But when a company starts to earn more and more, it always attracts others to do the same kind of business. And when competition starts to emerge in the market, to match the competition, the only thing that happens is they try to match the price. And finally, the market reaches to such a point wherein we attain the equilibrium of price, or we tell where the demand and the supply matches. Now, if at all the company produces goods or service which are not required by the society, then what happens is their price and profits definitely fall. Now, producers drop such goods and services with the intention of favoring other opportunities which are more profitable. Now, price system is one which directs all the managerial efforts towards more profitable goods or services. Now, the price we are speaking about, it is always determined by demand and supply condition as well as the competitive force, and they guide the allocation of resources for various productive activities. Now, discussing regarding this market economy, equilibrium of price, demand and supply, competitiveness, a question might always arise. Which questions whether the price system in a free market economy always serve the interest of the society. Now, to answer this question, we can take instance from Adam Smith. Okay, and according to Adam Smith, I quote, "The businessman, by directing industry in such a manner as it produce may be of great value, intends only his own gain, and he is in this, as in many other cases, led by an invisible hand to promote an end which was not a part of his intention. Pursuing his own interest, he frequently promotes that of society more effectively than he really intends to promote it. Now, this particular question was asked with the on the basis of profit maximization. We are now trying to discuss whether profit maximization as an objective is well off for the organization, whether it is to be taken up. And we also know that any organization, it might be, profit is necessary for survival. And we also spoke about regarding the price, how it changes in the economy. So the question is that whether this market system really be favorable to the society. And for this, the answer is given by Adam Smith, wherein he tells that yes, most of the businessmen, they start doing business with the intention of earning profit, and this profit they would be earning only for themselves, and there are chances that they do not think about other things. Yes, that is definitely the case. But then, when a businessman has this intention of earning profit and all the benefits for himself, in some other way, he would have done things which would be helpful for the society. Now, this stands good before many years. Now the things have changed, and now the things have changed in such a way that yes, profit is necessary, but the organization, not only in the indirect way, but in some direct ways, will also have to look towards the benefit of the society. Now, when it comes to this economics theory, the behavior of a firm will always be analyzed in terms of profit maximization. Now, profit maximization implies the firm either produces maximum output for a given amount of input, or it uses minimum input for a given output. Now, these two are the ways in which an organization can earn more profit. You either produce the output that you have to produce with the minimum input, or with the input that you have, you produce the maximum output. Now, the underlying or the basic logic of profit maximization definitely is nothing but the efficiency. Now, it is always assumed that profit maximization will always result in efficient allocation of resources under the competitive market condition, and profit is considered as the most appropriate measure of firm's performance. Now, let us try to see some of the arguments which are in favor of profit maximization as one of the objects of financial management. The first argument tells that the main purpose of most business is always to earn profit. Now, profit can be suitable criteria for measuring success of business operation, and it is always easy to measure and definite to measures. It is not based on the quality but on quantity. The third one, or the third argument, is that profit maximization will always ensure efficient utilization of scarce financial resources, as these resources are allocated to use which generates maximum profit for a company. And one more argument is that Profit maximization may sometimes lead to maximization of economic welfare of the society in which it is doing business. Now, since each individual component of society would seek maximum profitability, the economic welfare of society as a whole will always be increasing. Now, as we discuss the advantages, definitely there is objections. Now, one thing you should always remember is that profit maximization was the objective of business in the traditional era or during the early days of industrialization. But with the changing time, it definitely is shareholders' wealth maximization. So, before that, we shall try to understand the objections to profit maximization. Now, the profit maximization as an objective of financial management of a company has always been criticized. Now, it is argued that the for having profit maximization, it always needs perfect competition, and it goes without telling that perfect competition can never exist, and it is always the imperfect markets that is present in the modern days, and therefore it cannot be a legitimate objective of the firm. Now, it is also argued that profit maximization as an objective developed in the early 19th century, when the characteristics of the business was such that it could be like self-financing, private property, and there used to be single entrepreneurship. Now, the only aim of any single owner back then was to enhance their own individual wealth and personal power. Now, this could be easily satisfied by having profit maximization as objective. But then the modern business environment is you know, it has the characteristics which are like maybe limited liability, and there is always a divorce between the management and ownership. That is to tell, the management would be in few of the hands and it would be owned by different hands. Those who manage, you know does not have the power of the ownership, and those who own do not know how the day-to-day business is being done. And the shareholders and the lenders of today, they definitely finance the business firm, but the control and the direction would be in others' hand. Maybe in other, professional managers or management. Now, nowadays, it is not only, the owner, it's his money, or the business has to see how it will affect the creditors. But in the modern days, there are also other stakeholders of the firms, like the customers, employees, government, and society also. Now, everybody's interest has to be seen. And in today's practice, the objectives of these stakeholders or constituents of a firm differ and will always conflict with each other. That is to tell, The more the profit you give, you'll have less for the company. But if you have it for the company, maybe the value in terms of outsiders would be less, and so on. Not only that, the manager of the firm will always have the difficult task of reconciling, and also balancing these conflicting objectives. That is to tell, it is difficult to come off to a trade off. It could be many decisions. Now, all the decisions that are to be taken in modern day context is a two-dimensional decision. If it favors one, it would definitely disfavor the other. In this new business environment, profit maximization is definitely regarded as unrealistic, difficult, inappropriate, and also immoral. And it is also been said that profit maximization behavior in a market economy will and may sometimes lead to production of those goods and services which are wasteful and unnecessary for the society. Also, it might lead to inequality of income and wealth. And for all this reason, the government tend to intervene in the business. And it is when the government intervenes, the price system and therefore the profit maximization principle may not work due to imperfections in practice. Now, it could be oligopolies or monopolies. These are quite common phenomena of modern economies. Now, firms producing same goods and services differ, when it comes to the terms of technology, cost, and capital. And when we have such condition, it is definitely difficult to have a truly competitive price system, and therefore it is always doubtful if we can have profit maximization behavior which would optimize the social welfare. However, it is not clear that foregoing profit maximization as a decision would solve the problem. So, instead of that, there are chances that government intervention may be sought to correct the market in imperfection and to promote competition among business firms. Now, we should always remember that a market economy characterized by a high degree of competition would certainly ensure efficient production of goods and services that are desired by the society. Now, a question might arise which asks, is profit maximization is one which can be operated or which can be operationally feasible? Now we discuss some of the objections regarding the profit maximization. Adding to that, there is also this that profit maximization fails to serve as operational feasible criteria for maximizing the owner's welfare. Now it fails to provide an operationally feasible measure for ranking alternative courses of action in terms of their economic welfare. So, than this, whatever we discussed, some of the demerits could be, or the limitations could be, the first one is profit maximization as a criteria is very vague and ambiguous objective. That is to tell, the term profit is not specifically defined. It can be profit after tax or profit before tax. It can be total profit. It can be, incremental profit. Profit maximization they have definitely said, but they have not said which profit has to be maximized. The second limitation is that profit maximization as an objective does not consider time value of money. That is to tell, time of receipt of or receiving the benefits or cash inflows is not considered. According to this, it does not make any difference between cash inflows occurring at different point of time. But in reality, a rupee earned today will always be a rupee earned more than tomorrow. The third limitation is it ignores risk. Now, quality of benefit is also ignored. Profit maximization never considers the risk of not receiving or receiving less than expected cash flows. Now, the fourth limitation could be the objective of a business enterprise is not just to maximize profit, but also to create value for its owners. Now, one more limitation of profit maximization could be, on the basis of accounting profit. Now, these accounting profits can be easily affected by management through altering of accounting policies underlying the calculation of such profits. That is to tell, it is easy to manipulate. So moving forward, we discussed some of the points when we were trying to tell the limitation. One among that is definition of profit. And we said it is vague and ambiguous. That is to tell, the precise meaning of profit maximization objective is unclear. Now, the definition of the term profit is also ambiguous. So, ambiguous is not being clear or leading to confusion. So, whenever they tell profit, does it mean short-term or long-term profit? Does it refer to a profit before tax, or the profit refers to after tax? So, when you tell profit, is it total profit or profit per each equity share? And when you tell profit, does it mean to total operating profit or profit occurring to shareholders? Now, each one is different. Each one you get in different stage. So, which among these profits should be maximized as an objective is not at all clear. The next term that we spoke about was the time value of money. Now, the profit maximization objective really never takes the distinction between returns received in different time periods. Now, it never gives consideration to the time value of money, and it values benefits received in different periods of time as same. And also we have the uncertainty of returns. Now, the stream of benefits may possess different degree of uncertainty. That is to tell, two firms may have same total expected earnings, But if the earnings of one firm fluctuates comparatively as compared to the other, it definitely would be riskier. Possibly, the owners of the firm would always prefer smaller, but which can give profits to a potentially larger but less certain stream of benefits. Now, speaking regarding this, we'll also have to be clear regarding the maximizing of maximizing profit after tax. So let us try to put aside all the problem that we mentioned above and assume that maximizing profit means maximizing profit after tax. So let us just take for an instance. Now, in this sense of net profit, as reported in the profit and loss account, or what we call as income statement of the firm. Now, it can be realized that maximizing this figure will not maximize the economic welfare of the owners. Okay, what here trying to be said is that we have so many different options, or we are not clear regarding what profit has to be maximized. But for instance, let us take that the net profit is to be increased. Okay, one among the many options that we have. But then there are instances that the net profit need not be always mean that it increases the welfare of the owners, because even increasing the net profit is possible from different ways. Now, it is possible for a firm to increase the profit after tax by selling additional equity shares and investing the proceeds of this raised capitals in low yielding assets, maybe such as government bonds. This will result definitely in increase of profit after tax, but earnings per share would decrease. This can be explained with the help of figures so that it is clear. So consider that a company has rupees 10,000 shares outstanding, profit after tax of rupees 5,000 and earnings per share rupees 5. Now this is the basic stat of a illustrated company. Now if the company sells 10,000 additional shares of rupees 50 per share and invest these proceeds of rupees 5 lakh at 5% after taxes, now it would result in the after tax to increase by 75,000. But however, the earnings per share will fall to rupees 3.75. Okay. Now, this definitely tells that the maximum profits after tax does not necessarily be the best interest of owners. Now, that is to tell, what happened was the instance was given such that the shareholders of a company was okay. Now the shares of the company was 10,000 shares. Okay, and the after taxes, the profit after taxes was rupees 50,000. And the earnings per share. So when you have profit after tax 50,000 and the number of shares is 10,000, the earning per each share would definitely be rupees 5. Now, this is a simple calculation where you have rupees 50,000 as profit divided by number of shares 10,000, rupees 5 per share. But then the profit can be increased when, if the company sells additional shares. Now, additional equity share could be sold, maybe additional 10,000 shares. Now, when company decides this and that each additional share would be of rupees 50 each. So what happens in that case is the company would be getting rupees 5 lakh. Okay, and maybe the after tax is rupees 5%. Okay, and when the company goes in for such things, the after tax would be increasing to 75,000. That is because it is just nothing but calculation on the percentage. Okay, now, but when this happens, the profit would be 75,000, but the profit per each equity would be decreasing to 3.75, because now though the profit has increased from 50 to 75,000, at the same point of time the number of shareholders are also increased. Now it is not only 10,000, you have 10,000 plus 10,000, 20,000 shares. So when you divide 75,000 by 20,000, you will get 3.75 per share. So this example makes it very, very clear that maximizing profit after tax does not necessarily serve the best interest of the owners. And along with this, we also had a topic of maximizing earning per share. Okay, we can also take the instance of profit should be increased, but the profit of each of the equity should be maximized. Now, even this decision will not ensure the maximization of owners' economic welfare, because it also suffers from the flaws which we have already discussed, because it also ignores timing and risk of the expected benefits. Now, apart from all this problem, maximization of earnings per share has certain deficiency as a financial objective. One such deficiency could be, for one thing, we should remember that Maximizing earning per share implies that the market value of the company share is a function of earnings per share, which may not be true in many instances. That is to tell, if the market value is not a function of earning per share, then maximization of earnings per share will not necessarily result in highest possible price for the company's share. Maximization of earnings per share also implies that firms should never make dividends, or the dividends is always zero dividend for as long as funds can be invested in, possibly in some other internal project and some other positive rate of return, however small amount it could be. But making such a dividend policy will, may not be always be accepted by the shareholders. Now, so it is clear that maximizing profit after tax or earnings per share as the financial objective fails to maximize the economic welfare of owners, and that the both may be maximizing profit after tax or maximizing earning per share as financial objective fails to maximize the economic welfare of the owners, and that it ignores timing and uncertainty of the benefits. So, with all these objections to profit maximization, the limits to maximization of profit, and why it is not at all operationally feasible in the current times, the thing which solves all this problem is the objective of wealth maximization. Now, this objective is also considered not only clear, but it is consistent with the survival goal and also with the personal objective of managers, such as even the recognition, power status, and personal wealth. So, speaking about this shareholders' wealth maximization or SWM, in the modern phase, the objective of financial management is always to consider shareholders' wealth maximization, because it is based on the concept of cash flows, and along with that, it considers timing of benefits, and also it overcomes the limitation of profit maximization and always provides a realistic objective. Now, speaking about shareholders' wealth maximization, the shareholders' wealth includes market value of the company's shares, reserves and surpluses, along with the accumulated profits, if any. However, the main component is market value of the shares. So that's where we can try to understand that the market value of the share or market capitalization is nothing but market price per share into number of shares. Therefore, the financial manager should take all financial decisions in such a way that market value of firm's share is maximized. Now, since the number of shares remain fixed over a given period of time, the focus of financial manager should be on maximization of market price per share so that the shareholders' wealth is maximized. Now, for a financial manager, he might achieve higher share price quickly by selecting high risk or high return projects, but sometimes there are chances that this may backfire, which could result in a significant fall in the share price. And also, if shareholders are not satisfied with the functioning of the management or the progress that is being achieved by the organization, they can communicate their displeasure by selling the company's shares, which would, when done by many investors, result in the fall of the share price of organization. Now, speaking about shareholders' wealth maximization, it has for itself different other names. Some of the other names in which we can term shareholders' wealth maximization is net present worth maximization, or it is also being called as value maximization. Now, this objective maximizes the net present value of a course of action that is taken in the interest of shareholders. Now, shareholders' wealth maximization is always based on the presumption that the financial manager will seek to maximize the worth of shareholders' total investment. And it is in this regard that financial managers would want to maximize the value of all investment projects which the firm selects and also undertakes. And it is for this the net present value of the project is obtained based on its projected cash flow. It could be inflow of cash and also outflow and the cost of capital of the firm, or in other words what we call as discount rate. Now this net present value or NPV can be obtained by subtracting the present value of all the cash outflows of the project from the present value of all the cash inflows received during the lifetime of the project. For this session, let us wind up here, and for the coming session, we shall try to understand in detail what do we mean by shareholders' wealth maximization. I would take your attendance, then you can leave the meeting. Yes, thank you class for your patience listening. I will inform you regarding the next session. So let us discuss there regarding shareholders' wealth maximization and how is it better off to profit maximization.